I'm going to add on 10 minutes to the discussion to allow us to have a bit of a longer discussion, because we've had quite a few questions for all of you as well. So let me kick off with a few of them. So we've had several questions about the risk of a sovereign debt crisis, not this year, but maybe further down the line in several years hence. So how should we be bracing ourselves for another European debt crisis? I mean, let's assume, for example, that Italy doesn't recover its end 2019 real GDP level until 2024 or afterwards, that we see very meager nominal GDP growth. We see fiscal revenue stagnating or falling in the first instance. Debt to GDP ratios basically remaining elevated, very high. What happens then? How will the Italians be able to pay their way, and how long will markets continue to support Italy? And what if all that is happening against a very changed political backdrop? We have a different government in power, maybe led by Lega. Or is that an overly negative interpretation of what might happen? So, that's one obvious question, I guess, for Colin and Zsolt as well. How do you see that? That question's just being asked. There's a few other questions that have come in online, which I'll hold back for now. Maybe we can start with that. Colin?
Sure. Thank you very much, Joan. It's not the first time I've heard that question in the last few weeks. Again, just to reiterate, our approach so far is to wait and see what plans governments put in place once we are through certainly the trough of this crisis, and how credible we think those are in terms of restoring some of the fiscal space that will be used during this downturn. And we're going to get, we're at that trough pretty much now. It's probably going to be the second quarter of 2020 that's the low point in GDP around the world. So the recovery process will start very soon, absent some of the downside risks we may want to get into. But it's also going to take quite a long time. So, we're waiting to see what's happening here. It's absolutely true that central banks around the world, not just in the Eurozone, but elsewhere, have been stepping in to support governments, albeit indirectly, of course, because they're all focused on their inflation mandates. But I would share the assessment that this is a big disinflationary shock, which does warrant a policy response. Now, as to how those future developments are going to play out, there are clearly risks. There are absolutely risks, but I would say probably, particularly given some of the movements we've just seen around the new plan for EU borrowing on a higher scale, maybe those risks are a little bit more balanced than they've been in the past. We've known for some time that the Eurozone institutional architecture is incomplete. And our view at Moody's has always been that even if you complete the banking union with the common deposit scheme, even if you get capital markets union up and running, that does not obviate for the need for a proper fiscal union to support the monetary union that already exists. And that's really been the state of play for some time now. And we've seen kind of flare-ups to a greater or lesser extent. We've also seen creativity from the European policymakers in terms of how they've responded to some of those risks. But the fact that we now have, albeit a temporary mechanism, but we now have the outline of a mechanism which will involve large sums being redistributed from one EU member state to another. I know it's an EU mechanism, not a Eurozone mechanism. But there clearly has been a recognition by some policymakers that there is a need to do this right now. And that, of course, opens the door and opens the debate on what Europe would want to do the next time there is a negative shock, whether that's another kind of pandemic or indeed a market liquidity shock around funding costs for a sovereign. So I think we'll have to wait and see. But the risk you outlined has been there for a long time. It is not new. And I think I would come back to something that you made the point on very strongly about the politics. Clearly, there are political risks involved whenever you ask people to go through something that they are not keen to go through. And one of the real strengths of the Eurozone for me, looking back on the crisis, is the Greek population, for all of the incredible pain it went through the adjustment processes that the economy saw, their support for the single currency and for the Eurozone remained remarkably robust. Now, that is critical because ultimately the single currency is a political project. And we like to talk about the economics, we like to talk about the monetary framework and the other aspects that may or may not be happening. But you need sustained political support to keep this together. That's always been true of currency unions. And I think that's the kind of thing where we're just going to have to wait and see how this pans out. Certainly, if we saw a decline in popular support and we saw national politicians actively in power, kind of actively shifting away from their support for the single currency, that would be very concerning, as we've set out in previous research. But the kind of shocks that you're talking about in terms of financial markets, yes, they exist, but I think it's important to get them in context. So Italy, for example, has been running a primary surplus for quite a long time, if you look over the swathe of the past 2 decades or so. So a spike in funding costs there would be a concern, and it would be a signal from the market, but it's not necessarily going to crystallize into an outright shock particularly quickly, especially if you have this redistribution mechanism going on to provide Italy with funding, even if it's in 3 or 4 years' time, as Zsolt pointed out, because markets can be forward-looking and they can factor that in. So, yes, this risk is there. This risk has always been there. But actually, the latest news we've seen in terms of policymakers' response to downside shocks has actually been a bit more positive and shifted into this whole area of redistribution and fiscal transfers that before, as Zsolt said, I'm just not sure you would have seen.
Okay, thanks, Colin. Thanks for that full answer. Zsolt, did you want to add in your 2 pennyworth?
Yes. So certainly, I agree with Colin that we can be more hopeful now, partly because of this new EU budget proposal, even though, as I said, the expected net benefit to Italy would amount to 3% of Italian GDP, which is sizable, significant. But public debt of Italy this year could end up in the range between 160 and 180% of GDP, depending on how deep the recession will be. And 3% compared to that is a relatively small amount. Also, the ECB just yesterday increased its pandemic emergency purchases by an additional 600 billion euros. And if you look at Italian government bond yields, we have seen that they have been falling in the past couple of days. So the news from the side of the market are good for the time being. But I would like to emphasize that the time being part of my comment, because if we look back, let's say, to the past 3 decades, the past 30 years, then what we saw is that productivity growth in Italy was close to zero. There were hardly any productivity development in Italy. And there was a long divergence of Italy from the rest of the Euro area countries. For example, in the early 1990s, GDP per capita in Italy was almost the same as that of Germany. And now it is 25%, 1/4 lower. And, this past deteriorating performance is doesn't suggest a good outlook for the future. Now, Italian governments have introduced a number of useful structural reforms, and as an economist, I also hope and trust that these reforms would help to revive productivity growth in this country. But we have to see whether that actually happens, and if there would be a continued structural decline of Italy, but at the same time the current cyclical shock would last longer and become deeper than it's currently expected, then despite all the European Central Bank supports, markets indeed sooner or later might question whether Italian public debt is sustainable or not. So my risk assessment is somewhat higher than it seems Colin has. We have to wait, we have to see how things develop. But if you look at the more medium-term deterioration of the Italian economy, I think we have enough to worry that such a crisis might come.
Thank you very much, Zsolt. So just before I let Kostas come back, I just wanted to have a think about those. One for everyone, really, and maybe this is the one that we can finish off with, and I've got a few very particular ones before that, but one is, what is the new Europe growth model going to be after COVID-19? We've talked today about, and Kostas has done so again, about the very big sectoral and structural changes that are likely to be ushered in by this crisis. Tourism is going to take a long time to recover. Automotives, aviation, hospitality, all these sectors will be facing very big challenges. Trade is going to take a massive hit. Europe is very excellent on that front. Plus, we see increasing trade tensions, geopolitical tensions as well. And this comes on top of other very big structural growth deficits in the Eurozone, which Zsolt has already referred to, a very poor demographic outlook as well. So what's going to drive growth over the medium term in Europe? Now, every time that question is asked, we hear Green New Deal and something to that effect. So is there despite the funds that are being proposed now, and there's some slight change in the multi-annual budget of the EU, well, there's actually not that much change. Do you think, is there a dearth of ambition or a lack of imagination about the what needs to be done over the medium term to revive growth in the region? So that's a kind of a big question that maybe we want to come back to. Now, there's some specific questions from the audience. One for you, Zsolt, a question has come in asking you about, so this morning, Mr. Staikouras, the finance minister of Greece, was saying that the measures taken by Greece, 24 billion, equal to 13% of GDP. Now, that seems to be at odds with what you have discussed, well, at least the Institute, on the website, which seems to suggest that the measures are actually of a much smaller scale. So that's a very specific question to you, of about 4%. So, you know, is there a contradiction there or not? And following up on that, what should Greece really be prioritizing, do you think, in terms of utilization of 32 billion from Next Generation EU? So that's a question for you. So maybe, and then hold on, there's a couple of other questions that have come in. Okay, no, let's leave it at that. So maybe we can kick off with that. And who wants to start? Maybe you can clear up this. Is there any discrepancy there between the numbers that Mr. Staikouras was quoting and how you see things, Zsolt?
In our calculations, we discriminated between three major type fiscal measures. The first one is the immediate stimulus that we estimate around 3% in Greece, which means that there is additional public spending in addition to what was anyway planned in the budget. There are also tax cuts, meaning that tax cancellations, that companies and individuals don't have to pay certain taxes. So this is what we call immediate fiscal stimulus. But beyond that, there are also other measures, quite importantly, tax deferrals. So companies and individuals can pay taxes later. Now, this is a very important help, a very important liquidity help, but this is not a fiscal stimulus because, if value-added taxes have to be paid 3 months later or half a year later, still have to be paid. And the third type of measure is various kind of guarantees and other liquidity provisions. And also Greece adopted such types of measures. Again, it will be a government expense only if the guaranteed loans would actually default, or a part of them would actually default. But certainly, even if Greece will go through a very deep recession, not all the loans would actually default. So adding up these three different items, an immediate fiscal stimulus, tax and social security deferrals, and various kind of guarantees, I think gives a misleading picture of the overall fiscal response. So that's why I prefer to focus on the immediate fiscal part, by noting that the other types of measures are also very important.
Okay, thank you very much. So we are now, we've still got about 5 or 6 minutes left. So maybe we can hear from all of you about the growth model question. Maybe Kostas, you'd like to say something about that. Also, I think somebody chipped in a question referring to some of your previous contributions at some of our Economist events in Greece, where you'd really put the emphasis on the need for a huge investment program in Greece, and whether that's really, has that been derailed by this crisis, or actually could it be put back on track as a result of the proposal that's been put forward?
Thank you, John. Actually, this is, in the past, we used to talk about millions. Now we talk about trillions. So I would say that the question you pose, what kind of growth model we need to have in Europe, is the $1 trillion question, or euros question. Actually, it's a very tough equation that has to do with the new patterns, the consumer patterns, and the new developments in the economy. Now, we have a special situation right now. Usually in the market societies, the markets take initiatives, and with the incentives, new business models are created, or new industries are emerging. Nowadays, with this fiscal stimulus and the policy packages that have been put together, we have an institution, the governments, that are about to have a significant impact on the economy. So channeling these funds into various industries, and I think that this is going to be very important in terms of the new growth model. So the decisions the governments will make on how to channel these particular funds will dictate sort of the growth model of the economy. So these particular decisions are not just neutral decisions. Well, we're going to spend 20 billion in a country in investment and that's it. The industries or the initiatives in which this money will be spent will also direct or design the growth model of the economy. Just to give you an example, from what we hear here in Greece, this fiscal stimulus, we talk about investment, will be spent on tourism, right? Will be spent on the digital economy and the sort of reborn of the government and the public sector, right? Will be spent on education, right? A lot of training in that way, education, and also will be spent on the green energy, electricity and so on, renewable sources. Now, it seems that the Greek government makes a decision on how to spend this money, and therefore sort of designs in that way the new growth model. So what I'm saying is that the decisions the governments in Europe will make on how they spend this money, on the fiscal stimulus in various industries and various initiatives, will also direct the growth model of Europe. One last point. I strongly believe that the competitive advantage of Europe is the human capital, the educational system it has, and the knowledge economy. So I think that Europe, if we want to grow and have a future, we need to invest a lot on the knowledge economy.
Thank you very much, Kostas. Colin, did you have a perspective on this?
Yes, thanks, Joan. I think I agree with Kostas. Whenever we hear people talk about growth models, I'm never quite sure what they mean, because to an economist, in the long run, we know growth is driven by people, machines, and technology, or capital, labor, and technical progress, if you want to think about it that way. But kind of working out exactly how those manifest in terms of different sectors of the economy performing better or worse, or growth in any particular year being more consumption-driven than trade-driven, for example, will depend on a whole range of other things as well, including, as Kostas has said, preferences. And that's the big thing I think we do need to bear in mind over the medium term here. If you set aside the kind of downside risks of a second peak in coronavirus, you set aside the effects we know that can happen whenever you get unemployment stuck in the labour market around hysteresis, the changing pattern of preferences from consumers and possibly also from firms is going to influence how we spend and save our money, and that will have implications across a wide range of sectors and industries that, we can probably start to pick some that we think will do well, but we just don't know how all of those are going to play out over time. I think Kostas is right where, government intervention in certain sectors can kind of tilt the incentives one way or another. But ultimately, market economies go through change and thrive when things are allowed to go wrong without damaging the kind of broader economy. That's in essence, the ability to fail, and for people who took those risks leading up to the failure to bear the consequences and not to pass those risks on to others, is a really important part of how market economies work. So for me, I think we will need to see probably some support for risk capital coming out of this, because we're already seeing the shifts in spending and saving behavior, as Kostas mentioned. We're seeing companies kind of cut back on investment and guarding their cash flows very carefully. And that means that governments will be having to run deficits for a long time. So I think that focus on providing the incentives to enable people to take risks and try things is going to be really, really important in terms of helping the recomposition of the kind of sectoral makeup of the European economy. The one thing I would just emphasize, exactly as Kostas touched on in both of his remarks, is learning is really important here, not just in terms of how we learn how people will choose to change their lives after this, but also in terms of training. It's really, really important that workers are able to get access to the skills they need to move into new sectors or different industries as theirs come under more pressure and we see the layoffs happen. And maybe a final remark. I hope that Europe continues to be fully engaged globally, because for all that globalization has stopped or is maybe kind of heading into reverse slightly, I'm not sure I see Europe's future as kind of being a walled garden where it focuses very much on its own internal markets and its own interests. And that I think will be very important. Maybe not so much around things like human capital, because as Kostas says, Europe already starts from a very good position there. But in terms of the development and adoption of new technologies, I think that will be an incredibly important factor.
Thank you very much, Colin. Zsolt?
Yes, let me have 3 quick comments. The first one is that if you look at the past 20, 30 years, then Europe growth performance is not so bad after all. If you look at growth per hours worked, then it was very similar to what happened in the United States. But a European worker works on average 25% less than a US worker. So obviously the level of output per capita is smaller than in the US. But again, if you look at per hours worked, Europe didn't do that badly. In fact, it did very similar to the United States. There were exceptions. As I mentioned, Italy was very poor and Italy was falling behind. But there were also other countries growing faster. So that's the past. The second point is that there were many long-term structural trends or changes, which I think will be accelerated by the crisis, but these will not new things. I mean, everyone can recall how much we debated about the change of the nature of work even before COVID, where many non-standard forms of employment have been applied, or talked a lot about digitalization even before COVID, more automatization. In fact, even before the crisis, some manufacturing factories or companies repatriated their factories from emerging countries home because they were able to automatize so much that there was no much more advantage of employing much cheaper labor elsewhere. Now these trends will likely accelerate in the years to come. And my third point is related to the green transition, which I think can be indeed the defining force for the decades to come. At European policymaking level, I see a very strong determination for reaching carbon neutrality by 2050, which requires enormous amount of investment. Now, most of this investment will come from national budgets. So beyond national leaders agreeing to this goal, they have to implement, put in place, proper incentives for the private sector to invest more in green transition, and they also have to allocate more funding from national budget to public investment in this area. But if Europe would be able to indeed get a momentum on the green transition, that can define the future growth model of Europe.
Okay, thank you very much. So we have gone over time, so I just want to, before we wrap up, maybe to try and maybe end on a more hopeful note. I mean, we've actually heard quite a lot of hope this morning, certainly from the official representatives of the institutions, maybe a bit more sobriety or even skepticism from some of you. But are there any reasons to be optimistic about the next 2 or 3 years? Are there any upside risks to these kind of generally gloomy forecasts? Are there any silver linings? So maybe just if each of you could just take 1 minute to suggest anything on that score, and before we wrap up. So maybe Kostas, start with you.
Yeah, I'm optimistic because the last 2 months we all have learned a lot, and it is something that we have never seen before. Also, we have learned quickly that things are changing. Everything is changing. Everything changes all the time. But if we put our efforts together in a kind of collective way, we can manage most of them. And we can manage things that in the past, when we're thinking about those, we were saying, well, that we cannot do that. So I think that the last few months taught us how much the human being can do when we work together and when we collaborate together. So in my mind, that's very optimistic. I'm very optimistic about that, about this ability of the human being. And I think that the last couple of months, that's what we've learned a lot, all of us.
Thank you. Thank you very much, Kostas. Zsolt, anything optimistic from you?
Yes, I would mention 2 factors which can make us more optimistic. One is the public health situation, that it seems that the number of infections have been decreased faster in a number of EU member states than earlier expected. And in some countries already the various lockdown measures have been eased, schools have been reopened, and such measures have not led to renewed infections. Now, I'm not an epidemiologist, so I can't predict what the future would come, but at least somewhat better than expected public health outcome can make us hopeful. And the second relates to the policy response, both from the side of fiscal policy, namely the Franco-German proposal and the subsequent European Union budget proposal was really path-breaking, unprecedented in history. And also the European Central Bank adopted very, very strong measures. Even yesterday, despite that weeks ago, the German Constitutional Court made a ruling against the ECB public sector purchases. So this suggests me that policymakers this time are much more determined than they were before previous crises. So if the situation would deteriorate, that can make us more hopeful that they would find new solutions.
Thank you very much, Zsolt. So, Colin, last word to you.
I think I agree entirely on flexibility and policy response. Maybe my last cause for optimism is, although this could be a long crisis, if we get a vaccine more quickly, we would at least potentially have the option of returning to kind of life as we knew it more quickly. Now, we may not want to do that, and that will be in our hands, but I think that would be a very positive situation for us to at least be able to think about consciously what changes we wanted to make rather than those that we've had to make during this outbreak.
Thank you very much, Colin. So to close the meeting, I'd like first of all to thank the three of you for a really excellent discussion and presentations, and indeed to all our speakers today, including the panel this morning. Thank you everybody who joined. Thank you for your questions. I tried to take as many as I could. There were a few maybe that weren't taken, but we can pursue some of those at future events, I hope. Finally, I would like to thank the organisers of the event, Economist Events, our partners in Greece, Haslis and Rivas as well, and all our partners and sponsors for this event, including Katamarini newspapers. So I hope you all enjoyed the discussion. I hope we can repeat the exercise, and I hope before too long we will be meeting up again in Greece for our annual government roundtable. Thank you very much, everybody, and goodbye.